Assalamu alaikum. Welcome everybody to this seminar from myself, Faizal Karbani from Simply Ethical. We entitled this seminar, Work Smarter, Not Harder. And what I'm hopefully going to do today is, inshallah, share with you some financial planning tips, which will hopefully help you achieve your financial goals in a more effective and efficient way. By way of introduction, I just want to sort of talk about who we are as a firm and what we're trying to do. So Simply Ethical as a firm was established in 2009, and we're a faith-based organization. We're trying to help people live their lives, achieve their financial goals in a way which is compliant with their values and their faith. Alhamdulillah, we feel blessed to be Muslim. We feel that we have been given principles which are timeless, which are from the divine, and therefore, inshallah, they are beneficial for us all to adopt. And our aim really is to help Muslims do that, but also to showcase this to non-Muslims and hope that they will also adopt these values in the way they invest and manage their money. So we're a firm of financial advisors. We essentially are regulated by the Financial Conduct Authority, and we've been in the market since around 2009, 2010. Alhamdulillah, it's been a great journey so far working within the Muslim community in this country. Basically, what I want to hopefully get across today in sort of 30, 40 minutes is some key ideas. I want to sort of demonstrate the importance of financial planning. We as Muslims believe that Allah subhanahu wa ta'ala provides our rizq, our sustenance, but it's important. You may have heard the famous prophetic saying, tie the camel, and most of you, that will resonate with a lot of you. So essentially we have a responsibility to navigate this world in such a way that we try to be effective and efficient in how we do things. And with our finances is no different. We need to think about our needs, our goals, and then plan for it. I'll share with you some financial tips and some tools, how we potentially as a firm can help you. And then we're going to devote the sort of last part of the session to questions from yourselves. I think Islamic finance is a topic which certainly cannot be done justice in a few minutes, and many people, the label Islamic finance, underneath that there are many concepts and many things to discuss. In fact, I would go so far as to say there are whole degree courses on Islamic finance, so you can just see from that there is a lot which goes into it. But essentially, Allah subhanahu wa ta'ala has created this world, and the reality of this world that we have to provide for our families, we have to seek a livelihood, we have to deal with money effectively and wealth. And he set in his infinite wisdom certain parameters and guidelines for us to follow. And I think the biggest one, I've listed a few things here on this chart, on this slide, but effectively, a lot of these things you will kind of resonate with you. The biggest, I suppose, differential between us and the conventional world of finance is really the fact that the prohibition of riba. As we live in a society where essentially, interest is very commonplace. We go to the bank to borrow money, we have to borrow an interest. If we deposit money with a bank, we get interest. And so, when we buy goods and services, often we buy it on finance, and that's interest as well involved. So this is a problematic area, obviously, for Muslims. There's a clear prohibition in the Quran about riba, and therefore the mainstream scholars have basically said riba amounts to any form of interest, even if it's a small amount. And so therefore we have to try to find solutions which avoid interest in our lives, and that's not easy in the world we live in. But essentially there's a principles of Islamic finance which try to be then in the investment products, finance products which are out there, which are trying to inculcate these values in those products. And at Simply Ethical, that's what we do. We provide Sharia compliant financial advice and investment solutions and management based on Sharia principles. So essentially, this diagram here on this chart really talks about life stages a typical person goes through, and here you have various life events which you want to plan for. Ultimately, when someone grows up, leaves university or school, and starts to work, they will then start encountering their journey with money. They will hopefully get married, inshallah. They will look to buy their own property. Inshallah, they'll have children. They'll want to think about maybe private schools. If not private schools, then maybe university. And then, that period of, raising a family, and then, approaching retirement, inshallah. I mean, this is a kind of a generic diagram. And then clearly at the end of that journey, we want to distribute our wealth as well. And all of these things, there are, Islamic guidance and even when it comes to distribution of wealth, there are rules around how we leave our wealth to our inheritors, etc. So there's a lot to think about. And clearly all of us are on this journey, and we'll want to plan, or at least, provide for some of those life events. So that there is a need, if you want that journey to be smooth and as stress-free as possible, the best thing is to plan. So, kind of the steps to investing, often we can summarize it in this 4 steps. So identify your goal. It might be that I want to save enough money to buy a house. So, that might then translate into, I need to build a sufficient amount of deposit so that I can then get finance to buy the house I want. And then, essentially, as you're building that deposit, where do you park that money or invest that money is a question to achieve that goal. And then you choose the right investment and vehicle to do that. So, really the things that really come out of that is, what is your goal that you're saving for? How much you need in the future to do what you want to do? And then what does that translate into a regular saving amount, and for how long? So I want to share with you a very powerful example here, which when I first came across it was really kind of struck quite hard in terms of, we know these days to go to university, you're talking about maybe something around 18,000 per annum cost, because you've got the cost of obviously the tuition fees, which are £9,000-10,000. And then you've got the living expenses, accommodation, and everything else that goes with living when you go to university, living away. So, over a 3-year course, typically that will cost something like £54,000. And if you had the foresight to invest, early on with this in mind, what this shows you that you could invest £127 per month, basically at a growth rate where your investment's growing at 7% per annum. And over 18 years, you would get to that £54,000 target. If you delayed it by 5 years, the amount you need to invest per month jumps up to £215. So there's 2 or 3 key points here. One is that by planning early and, setting up something early on, you're taking the pain or the considerable pain out of that, the objective of up to get to £54,000. £54,000 is a lot of money. But if you can do it early enough, then the amount you have to save every month is relatively affordable. And the other key point is that if you delay it by 5 years, it actually shoots up quite a bit. So again, the pain of doing that, relatively speaking, for some people, it might not be much, but nevertheless, it's quite a big hike in percentage terms. So there's a really kind of powerful lesson here that, the sooner you start planning for things, and being able to have that discipline, financial discipline of looking at what you want to achieve financially, the goals you want to achieve, and then getting something in place to work towards that, the easier that journey is going to be for you. This is a really powerful example here, which basically I want to kind of just spend a little bit of time on. So some of you may have heard of compounding and the power of compounding when it comes to investing. And this really refers to the act of, putting your money in on a regular basis, letting the growth of that money, feed further growth. So, for example, if you put X amount into your an investment, let's say £1,000, and then that grows at 10%, for argument's sake. So by the end of the year, that's £110 or £1,100. Then that 1,100 gets reinvested, and let's say it grows at 10% again. So the following year, you've made £121 rather than £100. So you see the power of compounding as you are building that pot. The growth is upon a larger amount of capital, and it essentially builds like a snowball effectively. And the power of that is really demonstrated in this example. So you've got here two investors. The age is on the left-hand side, and you've got the investor in this example, investor A, putting in £2,000 per annum over a 10-year period. So over 10 years, this investor would invest £20,000. Now, the investment is growing at 8% per annum. And so you can see that how the value of that overall investment is increasing over time. And what this investor does is only invest for 10 years with a total investment amount of £20,000. And if he lets that investment grow beyond that 10-year period where he's actually putting money in, but actually leaves that pot to grow till the age of 65, then basically the pot grows to 291,000. So the return on that £20,000 is quite significant. It's grown by a significant amount. And essentially, if you compare that to an investor B who puts in 2,000 a year, but for a much longer period, so he starts and delays it compared to this first investor by 10 years, starts at the age of 35 and basically carries on till the age of 65. So he has invested effectively 31 years, 2,000 each year. So in total, he's put in 62,000. But because he's delayed it by 10 odd years, and then he's done it for much longer as well, but you can see he's invested 62,000, but his pot at the age of 65 is only worth £204,000. So there's a massive lesson in here in the sense that the earlier you invest and for the longer amount of time, the compounding effect of that investment is very, very powerful. And over, this investor A, having invested 10 years earlier, invested a third of what investor B has invested, essentially has ended up with a bigger pot and invested much less. So if ever there was an example of the power of compounding. So in terms of your own lives and in your own, and we'll talk more about this as the presentation goes along, but I think the key takeaway for everyone listening is that, if when you have your monthly income or your capital, your savings you're sitting on now, if there is the ability to invest and to do invest a regular amount from your disposable income every month, it's worth doing that as early as you can and on a consistent basis, so that over a period of time, 5, 10, 15, 20 years, you'll see the power of that in terms of the pot you'll accumulate as a result of the compounding effect. So that's really an important takeout from today. Now, for many people, especially in the Muslim community, they often shy away from investing because Islamic finance is still relatively young. They don't often understand what makes something halal. or Sharia compliant, and it can be maybe complex for people. So I'm trying to break it down. So there are many things you can invest in. A big favorite amongst the Muslim community and generally in the world is for property, for example. You'll probably have people in your family who have invested in property, and that's a common one. It's a nice, easy asset to understand. You buy a building or a property, and as a result, you either rent it out, you do it up and sell it at a profit or something of that nature. So essentially, that's one type of investment. What we do at Simply Ethical is invest in what we call regulated liquid investments. So these will consist essentially of funds. Again, those who are familiar with investing either through their pensions or they may have invested in ISAs, etc. You'll realize that there are a lot of funds out there, by people like Fidelity and Legal & General and all these household names, Standard Life, etc. They all offer funds where they invest money in a number of different things within that fund. Often there'll be shares in companies, so these are called equity funds. And essentially, an investment team will manage that investment on your behalf, and they will hopefully give you a return on that. So within Simply Ethical, as a FCA regulated financial advisory firm and investment management firm, we essentially deal with investments which are approved and registered by the FCA, which are liquid, so you can buy and sell these investments quite easily. Your money is not going to be stuck in without you being able to take it out. And that comprises of these type of funds which I mentioned, and there are different assets, if you like, that these funds invest in. So shares is one such thing, which are shares listed on a stock exchange. Then there are other types of funds like Sukuk is mentioned here under investment funds here, which are often referred to Islamic bonds. And it's probably beyond the scope of today to go into what Sukuks are, but essentially a Sukuk is represents ownership in some kind of asset or business where you're getting a return from that. So it could be a building, it could be a sort of a business that you're essentially investing in, or a service of some kind. But that's what a Sukuk is. You have the equity funds, you have things like property funds, and then you have things like commodity funds as well. Commodity funds refers to things like investing in gold and silver and other precious metals, and it could be also other things like oil and that type of stuff. So there are a number of types of investments. And now within the Sharia space, what we have is between funds and also investing directly in the shares of companies, what we call listed equities. There's more than 100 or so investments that we have access to in the UK, and we will use them to invest in for our clients into our portfolios at which we make up. So I'll explain a little bit more as we go along. As you'll appreciate with investments, there is a trade-off between risk and return. So with investments, often investments are talked about whether they're high risk, medium risk, or low risk. And this is a chart which is a very kind of generic indication of the different types of assets you can buy and the type of risk that you'll sort of take on. So, if you want the safest place to kind of put your money, then you might go to the likes of Gatehouse Bank or Al Rayyan Bank that have deposit accounts, which they are essentially paying a return on and paying a Sharia compliant return on. Then you have the Sukuk funds, which I talked about, which are really kind of assets which are giving a return, a rental return, for example. Property is probably like a medium risk, depending on how that is, what the investment is underneath. Will dictate the sort of risk that you're taking on with a property investment of some kind. And then, shares in companies and commodity funds are regarded as a bit more higher risk generally. But again, within that, there are different levels of risk that you will take depending on what you invest in. And then, private equity, venture capital is regarded as the highest kind of risk generally, because you're investing in not your sort of listed companies, which are very transparent, have to follow certain disclosure rules, etc. You are then investing in private companies, which are there's a lot less transparency and information out there with private companies. So you have to do a lot more due diligence, and it's regarded as more higher risk generally to do so. So yeah, that's kind of gives you a sense of the sort of assets out there which you can invest in. So really, you as an investor out there, you will consider something like Simply Ethical as one option to put some of your money or invest some of your money. You will consider maybe buying properties directly, which many people do. You may see businesses that you've come across in your life where you think, either yourself or through friends or people or even third parties who are looking for investment, you might want to invest in that kind of thing, in the business someone is setting up in your area or in an industry. So there are many different forms of investment that you can make. And I think, there's no one single answer that fits every single person. It depends on your situation, your experience of investing, how comfortable you feel, how much time do you have to look at investments and, sort of do all the work that goes into making investment decisions and monitoring investments and things like that. And that's where, financial advisory firms like us come in, because what we essentially offer is this ability for you to share your financial goals with us, your aspirations, and we can guide you in terms of a financial plan for yourself, where to invest the money, monitor that on your behalf, make sure it's Sharia compliant as well, etc. So the kind of, when you look at it holistically, it depends on what you want. But just to sort of open the box up a little bit in terms of the Sharia compliant side of things for equities, which is a key investment. So here we're talking about the shares that are listed on the major stock exchanges around the world. What can you buy as a share, for example? And the scholars were asked this question many years ago, and generally it's very simple. You can buy you can invest as a Muslim. You can invest into a business which is halal, which is doing halal work or providing a halal product. So that on one level, that's what we call the industry screen, which you see here. What is the business doing? And here, generally this is criteria which the industry follows generally. What is the industry screen that what are the businesses that we can't invest in? And these are some of the examples of the businesses which are listed here. Alcohol and tobacco, pork, obviously gambling, etc. And then the financial screen is the interesting one, which is maybe not so obvious. But what you essentially will find is that most companies on stock exchanges around the world will have debt, which is interest bearing in their businesses. And the question really the scholars needed to answer was that, well, obviously riba is prohibited, but is there any tolerance for the fact that it's so commonplace? Is there any tolerance for debt in how a company's financed, which is interest bearing? And the scholars basically opined that they will allow a certain threshold or a certain level of debt, given how commonplace it is, and given the fact that if they were to say have a zero tolerance policy, the stock market would become a quite difficult place for Muslims to invest in. And given the stock market's position in the world as a kind of a key place where capital is raised for many companies, where it's a marketplace for investors to put their money and invest in the economies around the world, they felt it was the right thing to do was to set a tolerance level and that's what they've done here. And you can see some of so essentially about 30% of a company's value essentially could be financed by interest-bearing debt. So that gives you an idea of how the Islamic finance industry is working and the type of funds we're using for the equity investments, the way they screen their investments. So what does that mean in terms of the companies that you actually invest in? I mean, there are many Sharia compliant funds out there, and you can see some of the names mentioned here on this chart: HSBC, Islamic. You can see some of the companies that they invest in. Essentially, Microsoft is there, Apple is there, Facebook, Tesla, etc. So again, you can see the iShares, MSCI, World Islamic, Johnson & Johnson, Procter & Gamble. These are household names. And, the emerging markets, Islamic talks about some of the companies which are abroad in some of the other economies around the world, etc. So yeah, and then on the last two at the bottom, you see basically essentially Sukuk funds, and you can see some names which are prominent, mainly the Kingdom of Saudi Arabia, the Sukuk Limited for project there. You have the DP World Crescent, which is based in Dubai, and so you have a number of different Sukuks out there which are Sharia compliant, and they where the monies are invested. So really, pressing on with time, it's flying by, so I'm just conscious of that. But essentially, when it comes to working smarter, I think, you really have to think about the tax side of things. And essentially, there are different vehicles which you can utilize to make sure you minimize the tax that you pay or get at least certain tax benefits. And a couple of the ones which I'll focus on is the ISA and the pension, which really form the bedrock of most people's financial planning in this country in terms of doing it in a tax efficient way. So the ISA is a vehicle that was set up a number of years ago to encourage people to invest in a tax efficient way. So here the idea is that an adult in this country will have a £20,000 limit to invest in a ISA. Over several ISAs now, they've relaxed that. So you basically, whatever you're investing in an ISA, it grows tax free. So the income and the growth you're getting in an ISA, you don't end up paying tax on. And so that's very, very powerful, because let's say you put 20,000 into ISA this year, and you keep the ISA running for the next 10, 15 years, that £20,000 can grow to £50,000, let's say, for argument's sake. So that £30,000 profit you've made within the ISA, because it's within the ISA wrapper, you don't end up paying any tax on it. So that's really powerful. And we know people and have clients who have built up ISAs over a number of years, and there's a significant amount of money in those ISAs, and you don't have to declare it also on your tax return. And you have a £20,000 limit. So between a couple, for example, they have £40,000 they can invest into an ISA. For children, you can set up a junior ISA, which essentially has a £9,000 limit. And what this essentially does, it segregates the money in the child's name. The child will not have access to that money till they're 18, but it's essentially a savings account for them, and you essentially can build up a nice amount of money for them for things like university when they turn 18, etc. In terms of pension planning, now pensions are a very important tool for planning for your long-term future and retirement. And basically, there is the tax relief side on the pensions is probably the most prominent feature, which is even in that sense is even more tax efficient than an ISA. The thing with pensions is that there is a lot of good tax relief that you get but it's a long-term vehicle where once you put your money in, you are essentially can't take that money out until the earliest you can take it out under current legislation is 55. So you're essentially in it for the long term. It obviously depends when you start using a pension, but the pension itself is also very tax efficient in the sense that there's no capital gains or income tax to pay on what is generated within the pension. And then at the age when you want to take money out from the age of 55 onwards, you can take the first 25% tax-free as a lump sum. Yeah. So, and usually pensions are outside of the estate for inheritance tax. I am very conscious of time, and I want to leave plenty time for questions. I won't dwell on this too much, but essentially you will have different types of pensions. You'll have the state pension. So when you come to retirement planning, essentially you should probably think about things like, what will be my state pension? What other sources of income will I have in my retirement? And then form a plan really based around what sort of income level you would like in your retirement, and then work backwards in terms of putting in place whatever you can to try to reach that income level. On the non-state pension sides, it's now very common and mandatory for every employer in the land to have a workplace pension. And so you will have your workplace pension schemes. And then you can also set up, in addition to any workplace pension scheme, or if you don't have one, you can set up a personal pension. So it's really, the question then comes is, are pensions halal? What makes a pension halal? And I think in terms of the normal pension scheme out there, which is what we call the defined contribution scheme, or the money purchase scheme, there are a few different things you have to make sure the pension does for you to make it Sharia compliant. First of all, the investments within the pension, you want to make sure they are Sharia compliant. So some of you might be listening to this and thinking, okay, I have a workplace pension, or I had workplace pensions, my money's invested in some funds. The first thing you need to check is are those funds Sharia compliant? And if they're not, can you change it to something Sharia compliant? On any cash within the pension, you want to make sure no interest is paid. And if it is, you need to understand what that amount of interest is so that you can then calculate it and give it away in charity to make sure that you're not benefiting from that. Annuities, when it comes to taking your pension, when you draw your pension, annuities is something which is an option. That is not Sharia compliant because it's related often to essentially interest-based products in the back end, which are generating that return. And there are other Sharia issues with that, which again, I can elaborate on another occasion, or anyone's got any questions, they can come back to me. And the death benefits, basically, you have the ability in a pension to essentially nominate your inheritors, which again, it's easy to do from a Sharia perspective. If you just nominate those beneficiaries in line with the Sharia guidance, then you should be okay. So the features of pensions which make it Sharia compliant are essentially around these four issues. The tax relief is significant in a pension. For basic rate taxpayers, is up to 20% tax relief. For higher rate, it's 40%, and for the top rate taxpayers who basically pay 45%, it basically would be 45% tax relief. Now, again, another very powerful example. I mean, the sums here are quite significant, but if you just take the principle from this, it depends on a person's ability to put whatever they can put into a pension. But if someone at the age of 30 started putting £1,000 per month to the age of 65 into a pension, at the age of 55, a 7% growth percentage, their pot, or their pension pot, would be worth 1.45 million. The really crucial thing to hear is that if you delayed that by 5 years and you start at the age of 35, the pension pot, because of this compounding effect, essentially drops down to just over 1 million. So significantly less than the 1.45. If you delayed it by 1 year, it would be 1.35. So still a significant difference, but not as much, obviously. And 3 months would make a £30,000 difference. So basically, you know, if you can invest as early as possible, save as much as possible, invest wisely, then that's, you know, you're going to make your, because someone with a £1.45 million pension pot is, you know, has the ability then to really benefit from that in their retirement years. Now, what basically the next couple of examples really are to do with the fact that, you know, if you are a high earner and your essentially your tax-free allowance is being tapered away at the rate of £1 for every additional £2 you earn over £100,000. One of the very common ways, which you may know from colleagues or yourself might be doing it, is something called salary sacrifice, where you essentially tell your employer that, look, I want to increase my pension contribution so my salary stays below a certain level. So let's say below 100,000 or 100,000, and the additional amount I want to put into a pension. What that will do, is that you will not lose your personal allowance, which is £12,570. So that's worth something. And you also get the tax relief on the pension contribution at 40% or whatever you're putting into the pension. So you're saving income tax at the rate of 40%. So essentially you are really saving in a significant amount of tax by doing that. So this is a financial planning tip, you can say, for those who are high earners that you can benefit from. And then really here, the example I was giving here was that if you're a self-employed person, you've got a limited company that you're working through. Now, if the limited company makes pension contributions on behalf of its employees or directors, then essentially they will save corporation tax, and the rate of corporation tax is 19% up to £50,000 of profit. Then it raises to 25%. So you're saving corporation tax at least at 19%. And then essentially, if you know, then from your post corporation tax profits, you paid out dividends and you were a high rate taxpayer, your rate of dividend tax would be 33.75%. So you end up paying a significant amount in corporation tax plus this dividend tax. You know, you're basically an equivalent rate of about 46% tax on, say, £10,000 or whatever the amount that is being earned by the company. By putting the money into basically a pension for that person, you save on the corporation tax and you save on this dividend tax. So you're saving a significant amount. Clearly, the thing with pensions, as I mentioned, is that the money is essentially locked away until 55. So you have to then weigh that up in terms of your immediate need for money versus that. And also another benefit is that basically you save on the employer's national insurance as well by putting money into a pension, because you don't pay NI on pension contributions. So really, very quickly, I'm going to just sort of now just go on to how we can help you. So the world of financial planning and financial advice has changed unrecognizably in the last sort of 5 to 10 years. The online phenomenon has really taken over. So people can now do a lot of financial planning almost on a DIY basis with all the financial tools and investments and options available online. And we as a business have adapted to that. We offer a solution online. We call it Simplified Advice Online, which is essentially the ability for you to set up an online account with us, open up an ISA or a pension or a general investment account, and basically start investing with us, saving with us on that basis. And the great news is that there's no upfront fees for doing it. It's very cost effective. It's very efficient and easy to do. And you have 24/7 access to this online platform where you'll be able to monitor your investments. And it's very flexible as well. You can take holidays from paying anything into the accounts. You can do it on a monthly basis. You can do it on an ad hoc basis. It's really up to what the person wants to do. And then really for those who have more complex financial needs, maybe they need someone to help them with a financial plan because it's quite complex, or they've got a significant amount of money to invest, something in the region of 2,000 to 250,000 or more, then it's probably worth having that personal financial advice service, because that your financial plan can be tailored for you, can be bespoke for you, etc. So as I said, the online service has a selection of tax wrappers. It's 24/7 access. Basically, the online journey will assess your suitability and tolerance for a certain level of risk, and it will essentially advise you to take one of our 7 risk-adjusted portfolios from low risk to high risk. And I would invite you to go onto our website, simplyethical.com, go to online advice, click on any of the accounts, pension, ISA, general investment account, scroll through, you'll see the performance of our portfolios, you'll see the charges, you'll see how we have made up of those portfolios, what investments we are choosing to put into those portfolios. And this is just some snapshots of what the journey you'll go through on the online platform, essentially, and what you'll see once you've opened up an account with us. The other thing I would urge all of you to do is that many of you are probably sitting there with pension accounts from different employers you've worked with over the years. What's quite common now, and you probably see this advertised around the financial press, or even if you're traveling on the tubes and posters, is that people are being encouraged to consolidate their pensions into one pot, because you may have worked in 3, 4, 5 different companies, different pension pots are there. It's useful to bring them together to one, so it streamlines the whole admin around it. You can keep an eye on it. But also from our perspective, it means that pots which may have not been Shariah compliant in the past, etc., you can put all of that money into one pot, and then you can essentially manage that one pot, with us, or we can obviously manage it for you. So consolidating your pensions is something which I think is something maybe you should consider if you are in that situation. And then we have this. Our roots have been always, since the day we opened Simply Ethical, is that we are a firm of financial advisors. We have qualified financial advisors in the firm, which will sit down with you and essentially discuss your situation, your goals, come up with a financial plan, and come up with how we would invest your money and for you to reach your goals. So that's essentially a service that we've always offered, and we continue to do so. And there is a protocol, a methodology of how we do that, and it's a very logical process of understanding your needs. The research we do, then we present recommendations. With your permission, we implement those recommendations, and then there's the ongoing monitoring and ongoing advice, because life doesn't stay in one state. Things change. You have to adapt. You have to change, you have to monitor how things are going. So really, that's the end of the presentation. Sorry, it's taken a bit longer than I thought, but if you have any questions, this is your opportunity to ask any questions. I will do my best to answer them. And if we, after today's session, please feel free to get in touch with us. You have our details there. We do offer a free 15-minute consultation, which you can book online with us or through our website, and we will essentially, through that consultation, answer your queries, etc., and help you in your financial journey. So yeah, thank you for your time, and I'll be delighted to take any questions you have. Yeah, so I've got a question here. Can you elaborate on junior ISA account? Yeah, sure. So a junior ISA account basically is just mirrors the adult ISA account, but it has some additional kind of rules to it. So first and foremost, it's for people under 18. you have a limit of up to investing £9,000 in a junior ISA account. And it has the same tax features as an adult ISA, so the money grows tax-free within there, but it's not accessible until the age of 18. So an adult ISA you can set up and you have access to the money at any time from when you set it up. In a junior ISA account, the money can only be accessed by the beneficiary, i.e. the child, at the age of 18 at the earliest. But before that, it cannot be accessed, the money cannot be taken out, etc. So I hope that explains it. Do you simply offer junior ISAs? Yes, so we do. So the platform we work with on the online solution is a platform called Fundment, and Fundment do offer junior ISAs, but in the way we have the solution that an individual can go online and set up an account with us, such as a pension or ISA, that facility has not been made available for a junior ISA yet. So a person cannot just go in to the platform and set up a junior ISA. The way that junior ISA can be set up is that if there is an adult account with us, if mum, dad has an account with us, for example, they can request for a junior ISA to be set up for their child, and we will do it. We will ask for certain information about the child, and we will do it for them. The fundment, work through the fundment system at our end and set the junior ISA up for them. But once it's set up, then it is visible with the adult account in terms of basically that account can be monitored online, can be seen online, etc. Yeah. So annual gift exemption is that they basically, so you can gift, when it comes to gifting and passing on wealth, there is this notion within inheritance tax law whereby if you are gifting something and you live for 7 years, then after 7 years it comes out of your estate. So generally, if I'm gifting a significant amount of money to someone I want to gift to, say my children, etc., out of my estate in my lifetime, then for it to come out of my estate fully, I have to wait. I have to sort of survive for 7 years, and then it's fully out of my estate. Otherwise, if I die within those 7 years, it will be regarded as part of my estate. If I die within 3 years of gifting, it's fully part of my estate. After 3 years, you start tapering down in terms of how much that gift is part of your estate or not. But what they've done, they've got some ancillary rules around gifting. So you can give up to £3,000 a year to your children, for example, and that will not be caught by those rules. That's an annual gifting allowance. There's also other rules around regular gifts out of your income. So if you are habitually giving a certain amount out of your income, then that can also pass through an exemption as well. So these are some ancillary rules around inheritance tax, against essentially, the rules in inheritance tax. Any other questions? So hold on. If I've paid income tax on the funds going into my ISA already, is there a way to have that refunded? No. So what you are essentially putting into an ISA is from your private money, which is probably going to be taxed money because you've earned that money through your employment or your business or whatever. It's in your private name. And an ISA is an individual account. So it's not a company account. It cannot be an institutional account. It's a private account. So it's from your taxed money. But yeah, although the investments within the ISA are now not going to be taxed in the sense that any growth or income, you cannot reclaim any tax you've paid on the income that you've now used to put the money into the ISA. So yeah, you cannot claim that. Yeah. So apart from ISA and SIPP, what other products do you have? So So we have the general investment account is there, which doesn't have the kind of the bespoke or the key tax exemptions that ISAs and SIPPs have. We can set up a junior ISA. We can set up a junior SIPP as well. But those essentially the kind of the tax wrappers we have. They are all tax wrappers. If you think of them as a vehicle within which investments are made, then basically the investments is where essentially we can then hopefully add value as well in terms of our portfolios we comprise, put together, and then the performance we derive from them. So yeah, that's essentially the tax wrappers we use. No, the ISA £20,000. Once you've the tax year is gone, you cannot, the allowance you haven't used in previous years or anything cannot be taken forward. That £20,000 limit is there for the tax year, and then once it's gone, that's it. The next tax year starts, and you get another £20,000 limit, but you cannot carry forward or carry back that allowance. Yeah, it's a good question. Are defined benefit pensions halal? So defined benefit pensions, the way scholars have explained it to me is that essentially it's an extension of your employment remuneration. So the employer is saying to you is that while you work for me, I'm going to pay you X, Y, Z. And when you leave or stop working for me, and after a certain age, that remuneration, there's a further part to your remuneration, and that is how much we'll pay to you in your retirement. And that's going to be a formula we're going to calculate. They have it sometimes as a fraction of your final salary or something like that. So essentially, there was some doubt expressed on defined benefits at one stage by scholars, because the argument there was that you don't know how long you're going to live for in your retirement, and how long that payment's going to continue for. And in Islamic terms, does that form a uncertainty in the commercial terms of your employment, and therefore does it render the contract as non-permissible? But when the scholars looked at this more closely and said, well, this is a uncertainty which is widely understood, it's a very generous type of arrangement, generally speaking, and it's something which is accepted in the market and by people, then they deem that uncertainty to be acceptable. And so therefore, to the best of my knowledge, defined benefit schemes are halal and are permissible, yeah. So are there investment solutions available with single director limited companies? Yeah, there are. So we do invest money for companies as well. So a company can set up an account to invest some of their monies. That's one option. Another option is that a director might set up a pension, so that the company can benefit the director by, like with the example we gave in the presentation, by putting money into a pension on behalf of the director. The company is saving corporation tax, and essentially the director is saving tax. You're building up a fund for the director, which is going to be also very inheritance tax friendly. So definitely. And then there is also a special type of pension scheme called a small self-administered scheme, SAS, which is specifically for smaller companies. It can have up to 11 members. And one of the features of that scheme is that the company can make contributions into that scheme on behalf of the directors, and the pension scheme can actually loan back money to the company, and that's only specifically for this type of scheme, SAS. So there is some very clever and good planning that can be done for directors and limited companies. So essentially there is definitely options for them. Yeah. So how do you manage individual risk versus fund manager risk appetite? So What we basically, I don't know if I've understood this question properly, but essentially, when you use our online solution or you come to us for a personal advice, we will assess your risk through the questions that I asked either online or through questionnaires we've used for our personal financial advice. And then that will inform our decision about what portfolio is right for you. And obviously, the portfolios we have are all risk adjusted. So on our online solution, we have 7 portfolios from very low risk to pretty high risk. And you will be recommending one of those portfolios based on the amount of risk that the system in this case is assuming you can take based on how you've answered those questions. And then the decision is made on that. So there's always, in the work we do, there's always a judgment call on what risk level and what type of portfolio is best for the client based on the information we know about the client, about their attitude to risk, about their capacity for loss, and their kind of general aims and goals. Is it wealth preservation? Is it to get the best possible return you can? So all of these things feed into it, and the investment portfolio should be a reflection of what all those factors come to kind of give us a conclusion on. Any other questions? Samir, Assalamu alaikum, Samir. Are there any plans on enhancements to the fundment platform? If yes, when? Yes, so there are. So the sort of things that we are looking at is basically to make, for example, the junior ISA hopefully available over time. We are also, hearing our clients talk about that they would like more choice potentially of choosing their own portfolio rather than being dictated by the system. So we are looking to try to make that change with time. I'll answer your question on time in a second. Also, we're looking to launch an app for the online solution as well. Now, when will these changes happen? If everything goes to plan as we're planning, then hopefully within 12 months, inshallah, we'll have quite significant changes to the online, hopefully making it more user-friendly with the app and some other additional features about flexibility of choosing which portfolio you want. We also hope to introduce some more investment solutions as well, investment products. So yeah, there is a drive to make things better and change things. And I'm thinking of 12 months from now would be hopefully the best indication I could give you. Yeah. Any other questions? Thank you for that great comment. Thank you, Nasser. Anyone else? I think we're coming up to an hour. I don't want to overburden anyone beyond a reasonable amount of time, but I hope you found it useful. Please do get in touch with us. We do offer this 15-minute free consultation where we'll have a Zoom call with you, and we will, hopefully be able to talk about your own particular situation. And yeah, we can go from there. But please do also look on our blog section. We have lots of videos like this, articles which give you lots of good information about products, the market, Islamic finance, financial planning. So hopefully you'll find that a great source of information. But thank you for your time, and hopefully catch up soon. So the one last question: can a defined benefit pension with civil service be transferred to Simply Ethical to manage? It's possible. You need to book a call with us. It's not straightforward because defined benefit pension schemes do require, the FCA require it to go through quite a rigorous process of financial advice. But there is a way of doing it. So you just book a consultation with us, and we can explain more. But thank you very much. Jazakallah khair. All the very best. And inshallah, we'll hopefully connect with all of you at some point in the future as well. Inshallah, we'll be looking to do these monthly seminars. So please do look out for the next one, inshallah. Assalamu alaikum.